Hello, welcome to Capital Sensei. Today we're going to dive deep into a book that caused quite a stir in the investment world for its sheer simplicity and powerful results. The Little Book That Beats the Market by Joel Greenblatt. We'll unpack his famous magic formula, breaking down exactly what it is, the two simple but crucial ingredients it uses to find great investments, and how you can apply it. We'll also talk about the most important part, the psychological fortitude required to actually make it work, which is often the biggest hurdle for investors. Whenever we can, we try to answer questions left in the comments. Investing can feel isolating, and sharing our experiences and questions helps everyone learn and grow. So please, feel free to comment with your doubts, share your own investment stories, or tell us what you think about Greenblatt's approach. This interaction is what builds a strong and supportive community. So let's start with the man behind the magic, Joel Greenblatt. This isn't some academic theorist living in an ivory tower. Greenblatt is a Wall Street legend. He's a professor at Columbia Business School, the same place where the fathers of value investing, Benjamin Graham and David Dodd, taught. But more importantly, he's a phenomenally successful hedge fund manager. His firm, Gotham Capital, delivered annualized returns of over 40% for 2 decades. When someone with that kind of track record decides to write a book explaining his method, and writes it so simply that he says his teenage kids can understand it, you should probably pay attention. The entire premise of the book is to demystify investing. Greenblatt saw the world of finance becoming needlessly complex, filled with jargon and experts who often didn't beat the market averages anyway. He wanted to give the average person a clear, mechanical, and proven method to do better. He built his entire philosophy on a very old, very wise idea, popularized by his predecessor at Columbia, Benjamin Graham. It's the story of Mr. Market. Imagine you own a small share in a private business, and you have a partner named Mr. Market. The thing about Mr. Market is that he's a bit unstable. Every single day, he comes to your office and offers to either buy your share or sell you his at a specific price. Some days, he's euphoric. He reads nothing but good news, thinks the future is blindingly bright, and offers you a ridiculously high price for your share. On other days, he's a depressive wreck. He's convinced the world is ending and offers to sell you his share for pennies on the dollar. A foolish investor gets caught up in Mr. Market's moods. They get excited when he's euphoric and buy at high prices, and they panic when he's depressed and sell at low prices. The wise investor, however, does the exact opposite. They ignore his daily drama and see him not as a guide, but as an opportunity. They happily sell to him when he's wildly optimistic and offers an absurd price, and they eagerly buy from him when he's panicking and offering a true bargain. The magic formula is, at its heart, a systematic way to exploit Mr. Market. Market's mood swings. So what is this formula? How does it mechanically find these bargains? It's surprisingly simple. The goal is to achieve what every great investor, from Warren Buffett to Peter Lynch, has tried to do: buy good companies at cheap prices. The formula just gives us 2 specific metrics to define good and cheap. Think of it like shopping for a used car. You don't just want the cheapest car on the lot because it might be a rust bucket that breaks down tomorrow. You also don't want the highest quality car if it costs a fortune. You want the sweet spot, a reliable, well-made car that you can get for a fantastic price. The formula identifies this sweet spot by ranking companies based on 2 factors. The first factor answers the question, is this a good company? Greenblatt measures this using a metric called return on capital. Now don't let the name scare you. The concept is really intuitive. Imagine you want to open a lemonade stand. You spend $100 on a table, a pitcher, lemons, and sugar. This $100 is your invested capital. At the end of the summer, after all expenses, you've made a profit of $50. Your return on capital is 50%. You turned every dollar you invested into 50 cents of profit. Now imagine your friend also opens a lemonade stand. They spend $200 on a fancier setup, but only make a profit of $40. Their return on capital is just 20%. Clearly, your business is much better at turning invested money into actual profit. You have a higher return on capital. That's all it is. A company with a high return on capital is a high-quality business. It's efficient. It's a money-making machine. It shows that the company's management is brilliant at taking the money they have from shareholders, from lenders, and using the company's assets, its factories, brands, and technology to generate big profits. For the more technically curious, the specific formula Greenblatt uses is a little more refined. He uses return on tangible capital employed. The calculation is EBIT divided by the sum of net working capital and net fixed assets. Now, let's break that down without getting a headache. EBIT stands for earnings before interest and taxes. Greenblatt uses this because it allows him to compare the core profitability of businesses without the noise of different debt levels or tax situations. It's a way of comparing the lemonade stands themselves, not how they were financed or where they are located. Net working capital is essentially the money a company needs for its day-to-day operations, like the cash you need for lemons and sugar. Net fixed assets are the long-term investments, like the cart and the pitcher. By using this specific version of return on capital, Greenblatt gets a very clean look at how good the actual business is at generating cash from its core operations. A high return on capital means you found a good company. That's ingredient number one. The second ingredient in the magic formula answers the question, is this company cheap? For this, Greenblatt uses a metric called the earnings yield. Many people are familiar with the price-to-earnings ratio, or PE ratio. The earnings yield is simply the inverse of that. It's the E divided by the P, and it's much more intuitive. If a stock costs $100 per share and earns $10 per share in profit, its PE ratio is 10. Its earnings yield is 10 divided by 100, or 10%. Thinking in terms of yield is powerful. If you were offered a bond with a 10% yield, you'd understand that immediately. You get $10 of interest for every $100 you invest. The earnings yield looks at a stock the same way. It tells you how much profit the business is generating for you relative to the price you are paying for it. A higher earnings yield means you are getting more earnings for your money. It means the stock is cheaper. Again, Greenblatt uses a slightly more sophisticated version in his formula to get a truer picture. Instead of just using the price or market capitalization, he uses something called enterprise value. This might sound complicated, but it's a really smart and simple idea. Imagine you want to buy a house that costs $500,000. That's the price. But the current owner also has a $200,000 mortgage on it that you would have to take over. And inside the house, there's a safe with $50,000 in cash that you get to keep. What's the real price you're paying for the house? It's the $500,000 price tag, plus the $200,000 debt you're assuming, minus the $50,000 in cash you get. The true cost, the enterprise value, is $650,000. It's the same for a company. Enterprise value is the market capitalization plus all of its debt, minus the cash on its balance sheet. It's the theoretical takeover price, and a much more honest measure of what a company truly costs than its stock price alone. So the earnings yield in the magic formula is calculated as EBIT, that same measure of core profit we saw before, divided by enterprise value. By using this, Greenblatt finds companies that are genuinely cheap relative to their core earning power, once you account for both their debt and their cash. It's a robust way of finding a bargain. So now we have our two key ingredients. We have return on capital to find good businesses, and we have earnings yield to find cheap stocks. The magic is simply in how Greenblatt combines them. It's a beautifully simple ranking system. First, you take a big list of stocks, say the 3,500 largest stocks on the US stock exchanges. You exclude utility and financial stocks, as their structures are unique and don't fit the formula well. You also exclude very tiny companies. Then, you calculate the return on capital for every single company on that list. You then rank all of them from number 1, the best, down to number 3,500, the worst. So the company with the highest return on capital gets the rank of 1. The second highest gets rank 2, and so on. Next, you do the exact same thing for the earnings yield. You calculate the earnings yield for every company on the list and rank them all again. The company with the highest earnings yield, the cheapest one, gets the rank of 1. The second cheapest gets rank 2, and so on down the list. The final step is the simplest of all. You just add the two ranks together. A company that was ranked 10th best for return on capital and 20th best for earnings yield would have a combined score of 30. A company that was mediocre on both, say ranked 500th on quality and 600th on price, would have a combined score of 1,100. The magic formula simply tells you to buy the companies with the lowest combined score. These are the stocks that offer the best combination of quality and price. Greenblatt doesn't suggest you pour all your money into the single number 1 stock. That would be too risky. Instead, he advises building a portfolio of about 20 to 30 of these top-ranked stocks. You can buy them all at once, or you can spread your purchases out over a year, buying a few of the top-ranked companies each month. This helps you average out your purchase prices and avoid being unlucky by buying everything at a temporary market high. And here's another key part of the process: discipline. You hold these stocks for 1 year, no more, no less. Why 1 year? First, it gives the market time to potentially recognize the value in the company you bought. A stock that is cheap today might not see its price rise tomorrow, but over a year, there's a good chance its true value will start to be reflected. Second, in the United States, holding an investment for longer than a year qualifies you for much lower long-term capital gains tax rates, which is a significant advantage. After the year is up, you sell the stocks. Yes, you sell them. Even if they've gone up a lot, even if they've gone down, you sell them, and you repeat the entire process. You run the screen again to find the new list of top-ranked Magic Formula stocks, and you use the money from the stocks you just sold to buy the new list. It's a continuous cycle of selling the old and buying the new, based purely on what the formula tells you. You are systematically clearing out your portfolio and reloading it with the best current opportunities. This sounds so simple, right? Almost too simple to work. But Greenblatt's backtesting, which he details in the book, is stunning. From 1988 through 2004, the portfolio of top-ranked stocks returned an average of 30.8% per year. For comparison, the overall market, as measured by the S&P 500, returned only 12.4% per year during that same period. The magic formula didn't just beat the market, it absolutely crushed it. So if this is so effective, why isn't every single person on Earth using this formula and becoming rich? This brings us to the most important lesson in the entire book. It's not about the math, it's about psychology. The formula is easy to understand. Sticking with it is incredibly, painfully difficult. And the reason is that the magic formula does not work all the time. It doesn't work every month or even every year. There will be periods, sometimes lasting 1, 2, or even close to 3 years, where a magic formula portfolio will underperform the general market. Imagine this scenario. You follow the formula perfectly for a year. At the end of that year, your portfolio is up 5%. But you turn on the news and hear that the S&P 500 index is up 15%. Your friends who just bought a popular tech stock are bragging about their 30% gains. Meanwhile, you're holding a basket of weird, boring, out-of-favor companies that the formula picked, and you're lagging behind. What do you do? The temptation to quit is immense. This is the great filter. This is where most people fail. They lose faith during the inevitable periods of underperformance. They conclude the magic is gone and abandon the strategy, usually at the worst possible time, right before it's about to start outperforming again. Greenblatt is very clear about this. If you are not prepared to underperform the market for extended periods, you should not use this formula. It requires the patience of a saint and the emotional discipline of a robot. It's like a scientifically proven diet. The data shows that if you stick to the plan of eating healthy food and exercising for a full year, you are almost guaranteed to be in better shape. But the process is hard. After a few weeks of eating salad while everyone else enjoys pizza and the scale hasn't moved much, it's easy to get discouraged and quit. Sticking with the magic formula is the financial equivalent of refusing the pizza day after day, trusting in the long-term result even when the short-term evidence is demoralizing. Another psychological hurdle is the kind of companies the formula makes you buy. They are often not the glamorous, headline-grabbing stocks. The formula looks for value, and value is often found in places that are a bit ugly, a bit boring, or currently experiencing some kind of problem. The formula might tell you to buy a chain of hardware stores that had a bad quarter, or a manufacturing company in an industry everyone thinks is dying. It takes real conviction to buy stocks that everyone else is selling, even if the numbers tell you it's a good, cheap business. It's socially and emotionally difficult. So, how can a regular person even implement this today? Do you need a supercomputer and a degree in finance? Absolutely not. And this is another part of the book's beauty. Greenblatt made it incredibly accessible. He created a website, magicformulainvesting.com, that does all the work for you. You can sign up, enter a few parameters like the minimum size of the company you want to look at, and it will spit out a ranked list of the current top magic formula stocks. It completely automates the screening process. Now, a critical question is whether the formula still holds its edge today, so many years after the book was published. As a strategy becomes more popular, its effectiveness can sometimes be diminished. And it's true that the formula's outperformance may not be as dramatic as it was in the original backtesting period. However, a fundamental logic behind it is timeless. The principle of buying high-quality businesses at bargain prices will never go out of style. More importantly, the reason the formula works is rooted in human behavior, and human behavior doesn't change. Investors will always be prone to fear and greed. They will always chase hot trends and panic sell during downturns. As long as Mr. Market remains a moody, emotional partner, a disciplined, unemotional strategy like the magic formula will have an edge. The periods of underperformance that scare most people away are precisely what preserves the formula's long-term power. If it worked every single year, everyone would do it, and the advantage would disappear overnight. It is crucial to understand that this is not a get-rich-quick scheme. It is a patient, disciplined, long-term approach to wealth building. It's about methodically putting the odds in your favor, over and over again, for many years. It teaches you to think like a business owner, not a gambler playing with stock tickers. You're not buying lottery tickets. You're buying shares of real businesses based on their profitability and price. The true gift of the little book that beats the market isn't just the formula itself. It's the education it provides. It teaches you the fundamental principles of value investing in a way that is clear, engaging, and backed by evidence. It gives you a framework for thinking about the market that strips away the noise and focuses on what truly matters: business quality and valuation. In the end, the magic formula presents a fascinating paradox. It's a method so simple a child could understand it, yet it requires a level of emotional discipline that most adults lack. It offers a clear path to potentially beating the market, but that path involves walking through uncomfortable, unpopular territory and enduring periods of frustrating underperformance. The secret, then, is not in the calculation. The secret is in the conviction. It's in your ability to trust the process, ignore the noise, and let the simple, powerful logic of buying good companies at cheap prices work its magic over the long run.